Now, before we go into the refined products, we just want to remind you, please like, share, subscribe. Your support is appreciated. Now, when we look at just the average, you can see just what that shock to the downside was. But as we keep saying, we're the 4-week rolling average is more important. It helps to try to streamline some of these components. And right now, so the current drop is at 12.403 million versus last week of 14.35. One was too high, one is too low. But when we look at the average, which sits at about 13.5 million barrels a day of product demand in general, that makes a lot more sense, and where we think it's going to be within that range as we go through the next few weeks. We'll have a spike to the upside. We'll have something normalized to the downside. It's just going to be a matter of living within this this level for the most part as we go through the remainder of the next few weeks. This was just an interesting chart looking at, before we get in, of what jet fuel expectations are. This is just looking at the UN World Tourism. So again, this feeds into GDP. This feeds into what are people going to do. With the vaccine rollouts delayed in some places and new virus strains appearing, it is looking more likely that international travel could be stalled for years. The United Nations World Tourism Organization says prospects for a 2021 rebound have worsened. And this is just giving you an idea of what the expectations are within those countries. So when do you expect international tourism to return to pre-pandemic 19 levels in your country? It's kind of slipped out of 2021 and closer into 2023. 2022 has slipped into 2023, but you can see that they're starting to get a bit more positivity on the back end of that curve. And then when we look at when do you expect a rebound in international tourism in your country, on the left side on that yellow, you can see that just based on quarters, there's that movement into 2022 out of 2021. So it'll have a bigger impact, especially on the countries that rely more on tourism, specifically in parts of Asia and Europe. And obviously cities in the U.S. But this is just one to think about when we're talking about jet fuel and what is that jet demand going to be as we go through the remainder of really 2021 and projecting into 2022. So now that we covered that, let's look at distillate. So distillate had a nice draw of about essentially 5 million barrels. It was pretty much across the board, but it was really driven the most by Pad 1 of 4.4 million barrel draws. So you can see that every spot pretty much had a draw, but it was obviously lopsided and put into Pad 1. But that's also going to support those imports coming from Europe, from Asia, actually, as we have the commentary coming across now is that diesel diesel's coming into the U.S. Disti's going to continue to flow, so we'll continue to see that hit. And when we look at imports, you can see that it was down 61,000 barrels a day, but it's still up year over year, 5-year average. This will surge again as we do get more flow coming into Pad 1. And just when you look at what Pad 1 Disti looks like, it's still 10 million barrels over the year over year, but it's now 1.2 million below the 5-year average. So we did see that heat spread open up that allowed that arbitrage to come through. So that will support those imports. And even before the winter storm, the arbitrage was wide open, allowing for that flow through. So again, this just keeps it supported. You can see that the drop accelerated, but again, as we see this restocking of heating, again, to heat in your home, because diesel is a big part of, or heating oil, or diesel, depending on where you are, is a big component to that. And now that freeze off has passed, we'll start to see this normalize, and we'll start to see. Now, the draws will continue, which is the pace will moderate as we go through the remainder of February and really through the middle of March. And here's what we're talking about, where we were expecting a drop down to the 5-year average. Here we are. We right at this point, we think it's going to kind of match that 5-year average as we go forward, just because, which means that we'll have probably another dip down and then a bounce back up, or we'll have a bounce back up first and a dip back down. But again, it's going to average out over the next 4 weeks to be at that 5-week rolling average, just because we're starting to see some of that adjustment as we look into the into the demand factors. Now, when we look at trucking, nobody should be surprised that there was a surge just because trucks weren't available, trucks were stuck. You had interstates that were locked down because of the freeze-offs. So that pushed, obviously, load availability and truck demand to the stratosphere. That will normalize and the reason why it'll normalize is because you have to look at what did rates do, what did truck availability do. So again, this is where the loads were available, which implied that there was a lot of trucking demand that will start to come back down. We'll still be within this, let's call it, at this point, 115 to 125, but it just shows just how much of a disruption we really had in the sector in general, and that will start to abate as we come to the kind of some of that normalcy. And the same happened in rail. There's only so much that can be done when you look at what the impacts are. So when we look at year to date, those numbers are still going to hold firm. We did have a derailment and an explosion of a petroleum rail cars. It's unfortunate, but again, it comes to pipelines versus rail capacity, which is a separate discussion, which could take a podcast on its own. So we're just going to talk about really what is happening here. So total car loads were down 28.3%. The ones that will continue to see that stress is obviously going to be on the coal side, the metallics, motor vehicle, non-metallic. We're seeing a slowdown in Ford, GM, just because of that chip shortage, which we're going to talk about in the economy show. But obviously, even with everything that happened, grains was still basically flat, which shouldn't surprise anyone given the amount of inflation in food and the demand going into the international market. That will not change. That will continue to outpace. The intermodal will get a snapback. Again, it's just going to be a matter of time overall. But the one thing that we've been saying, and it's really showing true in that year to date, total intermodal units will be in that upper single digits, and as we've been saying, kind of between that 6 and 8% versus last year. And then that'll obviously blow out wider when we start going into the COVID issues. But it's just giving you an idea of that there's really we don't see too much of a change. And this will be a nice tailwind for some of that diesel as we go through the remainder of Feb into March. Now, when we look at the port activity, you can see that there continues to be some slowdown as we go through the weeks in general, and they keep getting delayed. Again, it just comes down to having the availability. Now that we're getting pretty much PAD 5, I don't want to say back to normal, but more normal, this will allow and speed up some of these movements and pull some of this additional cargoes off the water. You can see that they're still elevated, obviously, when we look at versus previous year. But when we start looking at, and we'll talk about this more in the economy show, when we start looking at inventories are normalizing a bit. You're starting to see some of that normalcy come through, and just the increase in pricing on the import side is also going to slow the amount that people are going to purchase as we go into the next few weeks. And when we look at just number of port calls, so you can kind of see just where that number is. And when we go with number of daily port calls of container ships from Jan 2020 to January 27, 2021. So indices for export orders and automotive products, which are among the most reliable leading indicators for the world, have both peaked recently and started to lose momentum. In contrast, the container, shipping, and air freight indices are both still rising, although higher frequency data suggests that container shipping has dipped since the start of the year. Finally, while the indices for electronic components and raw materials are firmly above trend, this could reflect temporary stockpilings of inventories, as we've been saying. Taken together, these trends suggest that trade's upward momentum may be put to peak if it has not already done. Port calls in January were down around 7% compared to December and 6% compared to the average of July through September of last year. And this suggests that the second wave of COVID will have an appreciable impact on shipments of goods by sea, which is not yet fully reflected in the goods trade barometer. So again, we're starting to see some of that normalization that we've been talking about, and we're just starting to see those impacts as we do get that restocking complete. Now, when we look at the finishing the diesel side and the distillate side, you can see just where the heating normalization is happening. We're going to be now back above average as we go through. Essentially, every place that was frozen is now going to be thawed, and places that were either normal or slightly above are now going to be cold again. So we're getting some of those swings back. which again will just impact what heating demand will look like, and then soften some of that distillate demand on the heating side. Now, when we look at gasoline, gasoline had a small build of about 12,000 barrels. It was pretty stable across the board. Pad 1 was a small draw, Pad 2 small draw, Pad 3 small build. And this is all coming as we did have pipeline disruptions, which left some stock in Pad 3. We did get a massive decline in just activity, when imports also dipped by 141,000 barrels a day. But you can still see, even though it fell, it was still up year on year and still up on the 5-year average. And just given where the arbitrage remains, we're still going to see those imports coming into both Pad 5 and Pad 1. So we're going to catch it on both coasts, which again will and just given where the tightness in the market was, which has started to abate as we look at some just normalcy coming into the front end of the RBOB curve. But again, it's still elevated in general. But with all of that being said, we're now back above the last year. We're over the year over year by 700,000 barrels, the 5-year by 2 million, and we're now at that seasonally adjusted all-time high, and really the highest that we've been at since 2021 began. Now, when we look at blending components, there was a little bit of a drop just because ethanol had a big drop. We had to replace with some of that blending side. So again, it's just going to be that timing delay. We will get a gasoline drop in stockpiles as we go through this week, just because of the demand situation that we'll talk about in a minute. Because when we look at just what the blending components are, even though it dipped, we're still at that 5-year high, we're year over year high, so we're still setting that record. But when we look at supply data and the demand data, you can see that we had that steep dip. But what happens when you lose power? What happens when people get nervous and rush to go buy gasoline? You essentially draw down the inventory at the pump. So that has to be refilled. And as we always talk, there's a difference between what's in storage, what's at the racks, and then what is at the tank, at the actual local gas station. And when we put all of that together, you can see that we're going to get a little bit of that snapback just because we had the drop. Now some of these gas stations were running out of gasoline. They lost power. Now they can get their deliveries. That will pull more through the system. Whether that is this week or next week, we'll see some of this recovery in demand, which again will overshoot to the upside, and then it'll kind of normalize at what we think is that 8.1, 8.2 million barrels a day of demand through the really the first few weeks of March. Now, before we get into gasoline factors, here's propane. You could see that we're really pushing the lows. We had a draw of essentially 5.2 million barrels. Year over year, that's down 24.6%, 24.6 million versus the 5-year, we're down about 9.4. This will start to abate a bit just because we're getting a little bit of a pushback on pricing into the export market, just because obviously prices have increased. This is something that will adjust as we go through. But as you can see, we normally draw this point in time. It's just the pace of draws is grossly outpacing the normal, which is a positive in terms of seeing some of the demand for NGLs. This also was a result of freeze-offs that existed in oil, in natural gas liquids, in just pretty much across the board. So this is something that will start to abate just because we have the demand drop. We just with the warming weather, we have a little bit of a dip in exports, and then obviously we'll have some of the production come back, which will normalize. We'll still have a draw, it just won't be to the same degree. And when we look at just what's happening in the U.S., we just like to look at things in general. So when we look at COVID cases, we've seen a continuation of a slowdown in cases. But when we look at the lockdown index, that has continued to move, a bit more movement. Now we're having a stringency index of closer to 60. Which again just means more people are going about. The jobless claims remains an overarching problem when we think about spending and activity, and what is the pull through or the push through of a continuation. And again, the cases has started to flatline, so that's going to be something to watch. It could just be, a little bit of a flat line, but so far the trend is intact. It's just going to be something to watch because we were thinking that we were going to get that little bit of an increase in March, where obviously, as we've been saying, not like we saw for the holiday, but a little spike in March and then that continuation to the downside. Now, when we look at just what has happened into replenishing the U.S., European gasoline arrivals into the U.S. jumped by 65% week on week in the 7 days through February 18th, while diesel inflows remained limited. According to the bills of landing, they will be increasing. Gasoline imports surged to 215,000 barrels a day versus 131 the previous week. And then this is just looking at more pull through that's going to keep coming into that pad 1 because this is originating in Europe. We do have jet fuel and gasoline that's originating in Singapore and South Korea that will be coming into pad 5. This is just looking at the mobility index. Unfortunately, I was hoping it was going to update in terms of where it is and how things have progressed now that we kind of factor in what the adjustments are. But we can expect this to have a pretty steep drop. But again, it's just going to be a seasonal capacity. And when we think about that drop, the Gas Buddy data is just showing, putting into I think a good chart form so you can see just how precipitous that drop really was, driven by the weather side. So Gas Buddy data essentially had the gasoline demand fell significantly last week. Sunday demand, though, when we think about week over week now, Sunday was up 5.1% versus the prior Sunday. Monday was up 10.6% versus the prior Monday. Again, as we see some of those adjustments, so Gas Buddy had expected about a 10% drop versus last week, and their model came in at 7.6, which is obviously very close to what we had. But then when we start to normalize, when we look at Descartes data, they had gasoline demand dropping 0.4% to coming into that 8.29 million or 8.3 million, essentially ending Feb 12. I'm sorry, the most recent, and then consumption has continued to decline. Again, it's those timing delays. Descartes, I'm sorry, that was from February 12th. The one from the most recent week was closer to 7.9. But you can kind of see how we're getting closer to kind of now we're going to start to see that come back. But there still was snow on the ground. There were still some impacts just given where the cold was, where some of the freezing was, which will be some residual into this week, and then start to normalize as we go into next week as the weather gets better. This is just looking at what that blip looks like. Obviously, workplace, people didn't go to work as much. We had that transit drop. So you can see just in general that the activity remains depressed even when we compare it back to the holiday season. So that's something that is, again, going to continue to weigh on that overall gasoline demand. Now, when we look at weekend versus weekday, we keep talking about how the weekends have normalized a bit, but weekdays continue to be the problem just because people aren't going back into the office yet. And that's really limiting just how much of that demand we're seeing into the that normalization of demand of gasoline. Now, when we look at Apple Mobility, you can kind of see where that impacts were. We're right at that baseline of about plus 3%. One of the benefits, though, we have seen a bit of a normalization in Italy and Germany, but again, that's going to be a separate discussion that we'll talk about in segment 3. But you can see that we're just kind of holding that line as there's not too much happening one way or the other. But when we talked about COVID, here you can see just that little bit of a tail that's forming in daily cases, a little bit of an increase in deaths, but obviously the hospitalizations are still moving on that positive setup. Daily tests are starting to flatline, and I know my daughter needed to get her COVID test. But again, we're coming into the change of season. I mean, who doesn't get sick in March? But because of protocols, that's going to mean that more testing is going to happen if you get a runny nose or in order to get kids back in school. New York is now talking about, New York City, I should say, is talking about reopening schools. That will free up some more people to obviously go back to work. And it's just going to be a matter of how much normalcy do we see and when does that start to kind of feed through into the data. Now, when we look at COVID around the world, you can see worldwide we're pretty much stable. The U.S. maintaining that downtrend. You can see that little pop at the tail end. Europe is fairly flat. Asia Pacific continuing to hold these recent levels. India is maintaining this pretty steady level. There's been now it's going to come down to provincial side. Some provinces have continued to see a drop. 2 provinces have kind of flatlined and seen a little bit of an increase. Again, that's going to just mitigate how quickly we're seeing that drop down. South Korea and Japan have actually started to see a little bit of an increase, but you can see that they're just essentially flatlining at these levels, and Germany continues to be in a positive move. So again, there's some good, some bad. Asia, a little bit of a slowdown, but Europe continues to be on a pretty stable path. Now, when we look at daily vaccines, I thought this chart would be a little bit easier to see, just so you can see the vaccine doses administered per 100 people. And the U.S. has stabilized at these levels, and it's just now J&J just got the approval. That is only 1 shot. They're just putting more vaccines into the arsenal will just speed up this process, these numbers, and we'll continue to see the U.S. Maintain a fairly strong dosing rate. The bigger issue is the slowdowns in Europe. They haven't really been able to close that gap, and that's been causing some strife. And now there's concern of how quickly do you reopen if you don't have the vaccines. But again, the case count is going to be a big driver, and the hospitalization rates, which are all moving in the right direction. So even if we don't, we will see some reopening, even if we haven't gotten to the vaccine level that was desired for Europe, just because there's some of that drive. And let's be honest, people are tired of being locked in their homes. Now, when we look at jet fuel, as we kept saying that there was going to be a pretty steady decline. The builds were about 60,000 barrels. We're still below year over year in a 5-year, but this demand is just not going anywhere. As we keep saying, it's going to stay between that kind of 750 to 1 million. And just based on timing, obviously a lot of flights were canceled, that's going to weigh into it. So demand in general is going to shift lower again. Now, when we look at total departures, we had a nice little pop in China, but it's really along seasonal norms given the fact that Lunar New Year has now ended. It's still well below where they were in December. So just to give you an idea of kind of where things are, the U.S. has stabilized. There isn't too much to say outside of China. The bigger concern that we're seeing going forward is there were also a few cuts to the March schedule. U.S.-based airlines reduced capacity for April by about 1,800 flights on average each day. These cuts are earlier than usual and sign of a potential weak demand because, again, you can buy tickets going all the way out. So as they see demand, if they aren't seeing people buying, then they'll start to take some flights down, try to, increase the amount of passengers per flight, decrease the amount of flights, try to protect cost. In China, following the large drop, flight numbers increased by some 50 on average each day, departures, but European flight activity continues to deteriorate. But again, it's just going to be a matter of how quickly do they start to reopen, and will they start to reopen without the vaccines as at the level that they want? The short answer is going to be somewhere in the middle. So we will get some activity, but you can get an idea that the jet fuel side still remains a problem. And this is just looking at the passenger side. We had another drop in the U.S. And you can see when we look into 19 and into 20 at the blue line, we normally get that spike. We normally have the winter break. We normally have activity, and we saw that in the same level. Obviously, I should say the same type of spike, not obviously the same level, but that is now normalizing back to where it was within that, what we've been saying about that 550 to 850 range on average as we go through the remainder of not just February, but into March, and that's being supported based on especially the flights available. Open table data is getting a little bit better. You can see that the push is going higher. Jersey's now more reopen. New York is increasing the capacity. California is starting to reopen as well. That is obviously pushing this higher, which is a net positive in terms of just activity. And here you can see when we look at open table regional breakdown, the weekends are, I think we can now kind of take this up just given what we're seeing. Now we'll probably see something closer to about down 35% year over year. And when we look at the weekday, we should be about 55% down year over year. So about 10% better on each side, which is a net positive. Obviously, you can see Germany, Ireland, UK, that those restrictions will start to adjust and get addressed. The question is going to be, is it some point in March or do they maintain it into April? that'll kind of continue to see what is that going to do as we head through the remainder of this month and into next month, to see how much normalcy, how much will people move around, because this has a direct correlation to what does gasoline demand look like, how much diesel is going to move, because obviously this is a big part of the supply chain. Now, in the next segment, we're going to go through in more detail U.S. exports and what does the global market really look like as we're heading into March.